What's up, world? Michael EJ here, coming with another video, different topics in the worlds of finance, business, and life. Today, I'd like to share two stocks I think will work really well in what I would call a mixed signal environment. And the reason I would call it a mixed signal environment is because both the market and the economy in general are sending mixed signals. Is everything all good, or are things about to crash? Unsure either way based on the signals versus what they showed in the past. But either way, these two well-known stocks will help you get double-digit returns for the next couple of months, no matter how the market goes. Alright, so let's get started from there. Now, the reason I say mixed signals is because, things are just going both ways. In one end, there's different signals are showing that the economy has little room left. Latter stages of a expansion environment, latter stages of a bull market, and I say that because of high stock valuations. They've been high for a persistently long time. You got the flattening of the bond yield curve. Treasuries is coming tighter, usually signs of bad things to come. And also, you have a historically low unemployment rate. Was it 4.3%? That's a ridiculously low unemployment rate. That's almost saying everybody's hired who wants to be hired. That's kind of the equivalent. It's tough not to get a job, essentially. All of these are different signs of there's little room to go in the market today. Little room for the economy. Things are going to flatten out and possibly start to come down. But there's one signal, one sign that's just not moving that direction, and that is inflation. This is the number that the Fed pays the most attention to. This is why they will increase interest rates or decrease interest rates. It's almost all connected to inflation. Growth too, but growth and inflation usually move hand in hand, in tandem. Growth is still there, it's still happening, but inflation isn't coming right behind it. Inflation has been historically low practically since the global financial crisis back in 2008, 2009. And it spiked a little bit, maybe just a couple of months ago, and again around 2014, 2015, but it's not at as high of a level as all the other indicators show. And because of that main signal, the inflation being still historically low, is just a mix-up. So on one end, you see majority are showing, we're at the latter stages. Things might get a little scary in the upcoming months. On the other hand, you got the main indicators showing, we got plenty of room to run. You like Donald Trump says that he wants 3+% GDP growth. That's saying there's a lot more GDP growth to go. So, which side are you going to take? All of these are just signs of what will be called a range-bound market. Range-bound stock market. And usually this is when there's mixed signals in the air in terms of the economy and the whole entire market environment. And usually companies, they continue to do well. They continue to increase earnings, do well, earnings per share, increase sales. They still do fine, but the market sentiment changes. It goes from optimistic to more pessimistic. So valuations actually come down a little bit. So you have earnings growth still happening, but you have a decrease in the market sentiment, decrease in valuations. Usually you're met in the middle of very low returns. Not that much happening. To combat that, however, we need to invest in stocks that have what I would call a more balanced expected rate of return profile. Returns primarily come from two sources: shareholder yield and earnings growth. Shareholder yield, so that includes dividends and buybacks, and earnings growth, simply the growth of a business and how it grows sales, profitability, etc. So usually in a bull market, the companies that have high earnings growth, they're the ones that take off. Versus in a bear market, when the market is doing really bad, terrible, more quality companies, more mature companies, they're focused more on the yield. They buying back stocks and they have high dividends. So you want to land somewhere in the middle. You want companies that have some earnings growth and some shareholder yield to fall back on in an environment where earnings growth continue to persist, but market sentiment might come down and stock prices will suffer. Now, the two companies I'm going to mention are both well known. And when I say well known, I mean very well known. First one is eBay. Now, eBay, they've been making kind of a comeback as of late. I mean, they kind of fell off, things kind of went to the abyss. They were very known, maybe pre-financial crisis, maybe even right after it. We know eBay a lot more from the marketplace that they have. And still growing, still doing well. And just explain that they're still doing well in this marketplace. They own StubHub, don't forget about that, very small amount, but own StubHub, and they also have a classifieds advertising business too. And lately, they've been doing pretty well in increasing sales, high reinvestment, and it's coming from the marketplace, trying to switch things up in the marketplace, not just letting other people sell on their marketplace, but eBay is getting involved in selling as well. There's different items where eBay themselves are selling, and they're selling at very competitive prices. And it's not only just that, you have more transactional revenue, so that's increasing. More transactional revenues on their platforms are increasing, and a lot of it's led by marketing. I don't know if you all paid more attention lately, but on TV, as well on internet, YouTube, all these sorts, eBay is really increasing the marketing efforts. Some people will see that as a sign of weakness. I see it as a position of strength, because you're investing in the right things. Increasing marketing will increase sales, and hopefully over time you can decrease marketing and sales can continue. And let's not forget, they have a strong presence internationally. That's where the presence is at. Almost half, if not more than half of their business is internationally, not here in the United States. And in this kind of murky time, you want a company that's not just focused here in the United States. So they have that going on, and their mainly shareholder yield is mainly buybacks. They just this past quarter bought $500 million worth of their own stock back, and they've just been authorized to buy as much as $3 billion worth of stock back over the next couple of quarters and years. That's a lot of buyback potential. So you have a company that's going to buy back a lot of stock and still increase earnings primarily by increasing sales. Sounds like a pretty good winner in this kind of market environment. Now, let's talk about the second company, much bigger, much more well known, Microsoft. Now, I would say look at eBay if you think things will stay as is today or the next couple of months. I would say look at Microsoft if you expect things to get a little worse. And it's only because there's not as much potential maybe in terms of earnings growth or operating earnings growth, but there's plenty in terms of shareholder yield. Now, let's look at Microsoft. We all know they're in mainly the business of licensing and supporting an array of software products, cloud-based services for both consumers and businesses. I mean, that's kind of their thing. Also got a little bit of online advertising. There's a whole bunch of different things that Microsoft does. Now, latest results, this past fiscal year they just had, it's been driven by a lot of increased revenue, mainly from productivity and business processes, as well as the intelligent cloud segment, which mainly means a lot of their business is being driven by other businesses doing pretty well. Now, if you expect things to kind of fall off, it's okay. I mean, Microsoft is well known. You almost need it. It's a need product. You need Microsoft to run your business, which is so great because even if things fall off all across the economy, you need to look at companies that have high recurring revenue. You know the revenue is going to be there, and for a lot of Microsoft's products, they're here to stay. I mean, who's going to get rid of Microsoft Office, for example, or who's going to switch over who's going to switch over for the cloud platform? You can't really do it. You have to stay with them no matter what. It might affect how things increase over time, but you have to stay with them. Also, let's not forget, they're decreasing costs, both gross margins as well as operating margins. And the main cost savings coming from operating margins, and it's from mainly restructuring costs. As you all know, Microsoft bought LinkedIn at the end of 2016. That deal closed. You also have little M&A transactions here and there with Microsoft, just trying to integrate everything. So that's coming along pretty well. So Here is another company that's doing pretty well. They're increasing sales. Margins perspective, I'm not so sure about, because I think restructuring charges are a short-term fix. It only helps in short term, but sales are increasing at a decent rate, at least at the rate of any other company in the market, if not a little bit above. And let's not forget, they have repurchased millions of dollars worth of stock and given out millions of dollars of dividends and shown the history of doing it over the past 5-10 plus years. And I am pretty much predicting that is going to continue. Just think that's part of their plan now. So there you go. 2 stocks, eBay and Microsoft, that maybe in the next, 3-6 months, you'll be surprised, they might offer up to double-digit returns. It doesn't sound like a lot, but in this kind of market environment, this might be the best you can do. I'm telling you, things are looking a little rocky right now. We don't know where the market's going to go, so it's best to play it safe. So remember, the market is sending mixed signals. Look for a balanced return. Look at eBay and Microsoft. Until the next time, peace.